October 29, 1929. Black Tuesday. The worst day in stock market history. Benjamin Graham is 35 years old. He's one of the most successful investors on Wall Street. His fund is worth over $2.5 million, equivalent to $45 million today. In 48 hours, he loses 70% of everything. His investors are ruined. His employees quit. His wife threatens to leave him. Most people would give up, declare bankruptcy, walk away from Wall Street forever. Benjamin Graham? He did something different. He spent the next 10 years studying every stock market crash in history. The 1907 panic, the 1920 depression, the 1929 crash. He asked one question: why do smart people lose money in the stock market? 1949. 20 years after losing everything, Graham publishes The Intelligent Investor. It becomes the Bible of investing. Warren Buffett reads it at age 19, changes his life forever. He says, "The best investment book ever written." Today, 75 years later, Graham's principles are still the foundation of value investing. Warren Buffett, Charlie Munger, Seth Klarman, they all learned from Benjamin Graham. So, how did a man who lost everything in 1929 create 20 principles that changed investing forever? And why does Warren Buffett say, "I'm 85% Graham, 15% Fisher"? Let's break it down. Principle 1. Mr. Market, the Manic-Depressive partner. 1934. Graham is teaching at Columbia Business School. He tells his students a story. Imagine you own a business with a partner named Mr. Market. Every single day, Mr. Market comes to your office and offers to buy your share or sell you his share. Some days he's euphoric, offers you $1,000 per share for a business worth $500. Other days, he's depressed, offers you $200 per share for the same business. Graham's lesson: you are not obligated to do business with Mr. Market. Only do it when it's advantageous to you. The stock market is there to serve you, not to instruct you. Principle 2. Margin of safety, the most important concept. 1930. 1 year after the crash, Graham is broke, but he's studying. He finds something incredible. Northern Pipeline Company is trading at $65 per share. But Graham digs into their balance sheet. He discovers the company owns $95 per share in cash and government bonds, just sitting there. Graham's logic: I'm buying $95 worth of cash for $65. Even if the business is worthless, I win. He buys the stock. Then he forces the company to pay out the cash as dividends. Result? 46% return in 18 months. Graham's principle? The secret to investing is margin of safety. Buy $1 worth of assets for 50 cents. That's your protection. Principle 3. Intrinsic value versus market price. Graham teaches his students, there are two prices for every stock. Intrinsic value, what the business is actually worth based on assets, earnings, dividends. Market price, what Mr. Market is willing to pay today, emotional, irrational. Example: a company owns $10 million in cash, $20 million in inventory, $30 million in property. Total, $60 million assets. The company has 1 million shares outstanding. Intrinsic value, $60 per share, minimum. But the market price? It fluctuates wildly. Monday, $40, undervalued, buy. Tuesday, $60, fair value, hold. Wednesday, $80, overvalued, sell. Graham's rule: price is what you pay, value is what you get. Never confuse the two. Principle 4. Net stocks, the hidden bargains. 1932, the Great Depression. Companies are trading for nothing. Graham develops his most famous strategy, net stocks. Here's how it works. Step 1. Take current assets, cash, inventory, receivables. Step 2. Subtract all liabilities, debt, obligations. Step 3. Result equals net current asset value, NCAV. Example, current assets, $100 million. All liabilities, $50 million. NCAV, $50 million. Shares outstanding, 1 million. NCAV per share, $50. Stock is trading at $30. Graham's logic. I'm buying the company's current assets at a 40% discount. I'm getting the buildings, equipment, and future earnings for free. Graham's results from 1932 to 1935. He bought 50 net stocks. Average return? 42% per year for 3 years. Graham's principle: buy businesses selling for less than their liquidation value. You can't lose. Principle 5. Defensive versus enterprising investor. Graham teaches there are 2 types of investors. Defensive investor wants safety and peace of mind. Minimum effort required. Diversified portfolio, 25 to 75% stocks, 25 to 75% bonds. Large, established companies only. Expected return, 6 to 8% per year. Enterprising investor wants higher returns, willing to do work, research, analysis. Buys undervalued, out-of-favor stocks, nets, special situations, bankruptcies. Expected return, 15 to 20% per year. Graham's advice: choose one. Don't try to be both. If you're defensive, stay defensive. If you're enterprising, do the work. Warren Buffett's take. I started defensive. Graham taught me to be enterprising. That's when I made real money. Principle 6. The intelligent investor, not the smartest. Graham's book is called The Intelligent Investor, not the smartest investor. What's the difference? Smart investor predicts the future, times the market, trades frequently, follows hot tips. Result? Usually loses money. Intelligent investor focuses on value, ignores market fluctuations, buys with margin of safety, holds for years. Result? Consistent profits. Graham's lesson. You don't need to be a genius to invest. You need discipline and temperament. Principle 7. Chapter 8 and Chapter 20. The 2 most important. Warren Buffett says, if you only read 2 chapters of Graham's book, read Chapter 8 and Chapter 20. Chapter 8. The Investor and Market Fluctuations. The Mr. Market Story. How to profit from volatility. Ignore short-term price swings. Chapter 20. Margin of safety as central concept. Graham's bridge analogy. If a truck weighs 10 tons, don't build a bridge that holds 11 tons. Build one that holds 30 tons. That's margin of safety. These 2 chapters alone are worth more than most investment books combined. Principle 8. Be a business owner, not a stock trader. Graham hammers this into his students. When you buy a stock, you're buying a piece of a business, not a lottery ticket. Stock trader mindset. Watches price every day, cares about momentum. Buys high, sells higher, hopes. Holds for days, weeks. Business owner mindset. Studies the business, cares about earnings, assets. Buys when undervalued, holds for years. Graham's student Warren Buffett took this to heart. I never think about the stock price. I think, Would I buy this entire business at this valuation? Graham's principle? Think like an owner, not a speculator. Principle 9. Diversification for defensive, concentration for enterprising. Graham has different advice for different investors. For defensive investors, own 10 to 30 stocks. Diversify across industries. No single stock greater than 10% of portfolio. Safety through diversification. For enterprising investors, own 5 to 10 best ideas. Deep research on each. Largest positions in highest conviction. Higher returns through concentration. Buffett's evolution. I started with Graham's diversification. Then I learned, put all eggs in one basket and watch that basket. Principle 10. The Graham number. Simple valuation formula. Graham created a simple formula anyone can use. Graham number equals the square root of 22.5 times EPS times book value per share. What this means? 22.5 equals maximum PE of 15 times maximum PB of 1.5. EPS equals earnings per share. Book value equals assets minus liabilities per share. Example, company has EPS, $5, book value, $50 per share. Graham number equals the square root of 22.5 times $5 times $50 equals the square root of $5,625 equals $75. Graham's rule. If the stock trades below the Graham number, it's potentially undervalued. If above, it's potentially overvalued. Stock trading at $60. Graham number is $75. Potential buy. Let's blast through Graham's final 10 principles. Principle 11. Don't try to time the market. No one can predict short-term movements, not even Graham. Focus on value, not timing. Principle 12. Dollar cost averaging for defensive investors. Invest the same dollar amount every month. Automatically buy more when prices are low. Principle 13. Financial history repeats. Crashes happen every decade. Bubbles burst. Panics occur. Study history to prepare. Principle 14. Ignore hot tips and insider info. If everyone knows about it, it's already priced in. Do your own research. Principle 15. Earnings are real. Stock prices are opinions. Focus on actual earnings and assets. Stock prices are just crowd emotions. Principle 16. Bonds provide safety, not returns. Graham recommends 25 to 75% in bonds for stability, not for growth. Principle 17. Avoid IPOs and new issues. IPOs are sold, not bought. Companies go public when prices are high. Principle 18. Read financial statements yourself. Don't trust analysts. Read the annual report. Check the footnotes. Principle 19. Patience is the investor's best friend. Graham held stocks for years, not days. Time reveals true value. Principle 20. The formula for success. Success comes from sound principles applied with discipline, nothing more. September 21, 1976. Benjamin Graham passes away at age 82. His legacy? He taught Warren Buffett, world's greatest investor; Irving Kahn, active investor until age 109; Walter Schloss, 47 years of 16% annual returns; Bill Ruane, founded Sequoia Fund. His book, The Intelligent Investor, is still required reading at every business school. 75 years later, his principles haven't changed. Warren Buffett's tribute. Graham gave me three things: a framework for investing, the courage to be different, and the proof that ordinary people can beat the market. So here's what you should do right now. Step 1. Read The Intelligent Investor. Go to Amazon. Buy Benjamin Graham's book. Start with Chapter 8 and Chapter 20. Warren Buffett reads it every year. You should too. Step 2. Calculate your first Graham number. Pick any stock. Find its EPS and book value. Calculate the Graham number. Compare it to the current stock price. Is it undervalued or overvalued? Step 3. Learn from Mr. Market. This week, watch a stock price. See how it fluctuates daily. Ask yourself, did the business change or just Mr. Market's mood? That's how you learn to separate price from value. Bonus: watch these related videos. If you loved this breakdown, watch Warren Buffett's 20 Rules, Graham's Best Student; Peter Lynch's 20 Principles, Beat Wall Street 13 Years; Charlie Munger's Mental Models, Graham plus Psychology. Hit subscribe. We break down legendary investors every single week.